Hello, and welcome to a new lecture from the Inner Circle Scorpio, decoded decoding ICT. Today's lecture is price and time cycles. So far, we have gone through how price moves, how time affects it, and how do we look at different ICT PD arrays. And then we also talked about time in the previous lecture, and today we will talk about their cycles, the price and time cycles. So let's just get started. For the price cycle, we will discuss how a price moves from A to B when IPTA, the interbank price delivery algorithm, is in bullish scenario where the price is going up and we want to find A and B and how we look at price in that scenario. Then same thing in bearish scenario, and in here we already talked about A as an inception and B as a terminus. That price goes from inception to terminus. And then a few things that are extra, which is we'll talk about low resistance liquidity run, we will talk about high resistance liquidity run, and these two concepts we already talked about. We will just reinforce them here: purge and revert and price continuation. Okay, so what I want to explain to you on price is that price always goes from A to B. We talked about this in, I think, the second lecture. You can go back and look at it, but what I want to tell you is that A can be any point in a bullish scenario. It can be um, an imbalance or fair value gap in which we went on a higher time frame and then we expanded, or it can be an expansion into a sell side liquidity and then we retraced back up on the upside. So A to B. So as you can see, here is the chart from that A point to that B point, and I want to show how the price moves there. We have certain levels on price. This can be 100, this can be 125, 150, 175, and 200. And I want you to see how price moves through it. It has to go to 200 from 100, and the first thing it do is it goes up, just touches the 25 level, goes down. Now most of the people would take this as a resistance on price and might short over here, but the price, what it does is on the next move it just goes through it. So this was an engineered high. We go through it. This would be a purge and revert of a sell side liquidity somewhere here into an imbalance, and then we push through the buy side liquidity. Now we retrace a little bit back on that same level. This would be a continuation model. The price goes down, rushes up. Now this time here it did not stop at this level. This shows high probability for the price to go to level B, because on the midpoint, the consequent encroachment of this price level from 100 to 20, it showed us a huge displacement with the fair value gap, most probably. Now the price cannot just go up in a straight line, it has to retrace back. It will retrace back into a fair value gap somewhere below that level one more time and then rushes up. Now here it does not go too much up and does not stop at this level exactly, it just goes a little bit up, goes down and goes up. Now the reason for showing this is that the price will go from A to B, but it cannot be in our perfect sense, like it should just touch 25, 50, 75 and go up. It has to move in its own way, and because it does not touch those level exactly most of the time, is we call that price distortion, because we have to allow the price to move a little bit up and down from that level. So that's how price moves from A to B in a bullish scenario. Same thing in a bearish scenario, where we see that there was a fair value gap above here in which the price went, and then it retraced back towards the sell side liquidity or we took the buy side liquidity and now we are going towards the sell side liquidity. We go down, go to the first level, to the tip, revert back, engineered low, we rush through it, break it, go up, engineered low, rush through it. Now this time we make a fair value gap towards the midpoint of this price level, which indicates that we have to go further. We go up, engineered low, we rush through it, we stop just below the 0.75 level, go up, this is engineered low, and finally we are at point B. Now what I want to explain here is that price will go from A to B. A is your point of interest where you want to take the trade, and B is your drawn liquidity where the price will go. The important thing is you can enter anywhere on this price level. You do not have to enter at this point. It's not necessary. If you can, that's good. That would be a low-risk trade, but it's not necessary that you enter on this. You can enter anywhere above this 0.5 level, or if the price risk to reward is good, you can enter anywhere here as well. If your price has not reached the drawn liquidity, you can enter. You can enter at this retracement back somewhere here in a fair value gap. You can enter on this retracement on this mitigation block. You can go down, enter on this fair value gap over here, go down, you can enter on this fair value gap. So all of these are valid entries unless the risk to reward is good for you. Same for the bullish scenario and same for the bearish scenario. Now the next topic we have already talked about is high resistance liquidity run. It just means that when the price is going from A to B, it takes a lot of time, or it shows a lot of back and forth. Like as you can see, it's not that much of a distance. Just went 100 points, but it went down, up, down, up, down, up, down, way too much up. Now some people will think this is a break of structure, so we have to go above here. No, it went down, up, down, up, down, up, down, up, down, up, down, make a high, then down. So this is a lot of back and forth. So when you see these kind of movements in the chart, you should stay away from them. Maybe skip a day on the trade, because high resistance liquidity run are very stressful. They're very hard on your mind and takes a lot of mental capital out of you because you have to look through it. I mean, it's good for you to build resilience, but you can build resilience if you can put a one micro contract to you towards your objective, and that's it. Look at the price, how it moves. That's how you build your mental resilience. Now the other example is low resistance liquidity run. In here, the price you entered at A on this breaker, for example, and the price just rushed up, retraced a little bit, rushed up, retraced a little bit, rushed up, retraced a little bit, rushed up. So these are the kind of scenarios that we want to be in. Although you might say that, okay, the other one took the same amount of time. Sure, but the other one also was a little bit confusing with all these big wicks up there. This is high resistance because on every PD array there can be a fair value gap here. It just shows a big move up. That means that we might not reach our objective. While on a low resistance liquidity run, it just respects the PD arrays and just goes up slowly. So we would like to be in a example in a trade where the resistance is low, so we can enter, and as soon as we enter we see no drawdown and we go up. It's not an ideal scenario, of course. We will see drawdown most of the time, but we want to be in an environment where we see least amount of drawdown, which would be a low resistance liquidity run. Okay, so once again we'll talk about the purge and revert. What is purge and revert? We have our drawn liquidity on the buy side, and we see that the price is moving here, and then it goes down, takes out the sell side, and immediately rushes up towards the buy side. This is called a purge and revert in a bullish model. Now, same scenario on this side, which is the price is moving, it takes out the buy side and reverts to the sell side. This is purge and revert on the bearish scenario. Let's take an example. In a macro time, which we discussed in the previous lecture, 6:45 and 7:15, the price comes down and takes out the sell side liquidity. It purged the sell side liquidity. It made an engineered low over here, went up into this fair value gap over here, and then boom, took out this both sell sides. Now, these are the three consecutive candles that took out this sell side. So we want the price to close above this. It closed, and now we can enter on this inverse fair value gap or on wherever the price is in this area. So then we target the buy side. So the price came, purged the sell side, and went towards the buy side. The next is the price continuation. Let me repeat that. I think I pronounced it wrong. Price continuation. Okay. The price is here. This is our sell side. The price does not just purge it, it just actually pierces through it, making a fair value gap, goes back up into that fair value gap, and then continues. This is a bearish scenario. On a bullish scenario, the price comes up, pierces through the buy side, makes a fair value gap, goes back into that fair value gap, and continues. For price continuation, we can take the same example where we took out the buy side in the previous example, in the previous macro over here. And the next macro, what the price do is when it goes through that buy side liquidity, it just continues and makes a fair value gap and it goes through it. Normally, the price will come back on that level, at least the 0.5, the midpoint of that, into a fair value gap, and then continues towards the newer buy side, the buy side above that. So this is a continuation model where we do not just purge and revert, we continue. This is a bullish scenario. Now, up until now, we have talked about price only, and it's really important to talk about time because without time, we cannot actually trade. So, in the time cycles, we'll talk about how the yearly cycles go, the monthly time, the weekly, daily session, and 90. And at the end, you will realize that all of this is the same. It's just on bigger level and smaller level. I will talk about the early time, and when I will talk about the 90-minute, you'll be like, oh, they're both same. The only difference is that this is in months and this is in minutes. That's the only difference. Let's talk about the yearly delivery of how the price moves. So we have to understand that whatever the price is doing is based on what it did in the previous year, month, week, day, session, 90-minute cycle. So when we are looking at the yearly delivery, if we are in the month of March, we have to see what happened in January and February, because price is dependent on what happened previously. An algorithm refers back to those price levels that happened at a certain time, and it refers back to it to deliver the price. So in March, let's suppose IPDA made some references in January and February where it goes back to deliver price. So we'll take an example for that. Let's suppose we take an example from February to May. You need to understand that price always moves in continuation and purge and revert. So in February, as you can see, the price made a fair value gap towards this low over here, which means a continuation. So on March, the price continued towards January 2024 previous year low. It came down, it purged that low, it did not make a fair value gap, it reversed, right? And then price reverses back and goes towards the buy side that was created in February. Continuation, purge, and revert. And you might have seen a lot of people taking a long in April towards the end of October, because that was a really anticipated long. We purged the previous year low and went towards the upside. It's the price moves like that. It takes the previous low, goes towards the previous year high, takes the previous year high, goes towards the previous year low, takes the previous day high, goes towards the previous day low. So price only moves like that. Okay, that was a yearly example. We go towards a monthly delivery where we look at the weeks. In a yearly delivery, we look at the months, and in a monthly delivery, we look at the weeks. So every month has 4 weeks, 1, 2, 3, 4, generally speaking, right? Every month have almost 4 weeks. So we see that this is week one. This was August, I think. I forgot to take the picture for the time. This is first week, second, third, and fourth. So what's happening here is that on the previous week we made a high and a low, and then we purged that previous week low. Now we know when, if the previous week low has been taken, where we should go towards the upside. So now we are bullish. Actually, in the first week we go up and take out the previous week, both of the previous week's high, this one and this one. Now obviously we have taken at the high, so we have to go down. We go down, making a fair value gap. This would be a continuation, but as you can see, we do not technically go down fully, because we also did a continuation over here. As you can see, the previous week high, we made a fair value gap, so that means we will do continuation, but we also have to retrace back at least 50% of the price range over here. This is an optimal trade entry. This is 0.62 to 0.70 price level, equal lows, and the price goes back up. Make equal low, and in the further continuation it goes back up. So continuation, this is retracement, continuation. As now you see how week one delivered, you can easily tell what the week three would do, at least, because in week two we will expect the price to take out these highs and then revert. Okay, so now we look at the weekly delivery. In a monthly delivery we were looking at the weeks, and in a weekly delivery we will look at the days of the weeks: Monday, Tuesday, Wednesday, Thursday, and Friday. Very you'll be like, oh my god, this is how price moves. We can just put a small order in, and at the end of the day just take it out. So we take up example of the Monday through Friday of some time. I think October 11. No, it's not October 11. It's not showing day. Anyway, let's just take an example because the time and price is here. So Monday opens over here. We make a low and we make this high. Come back into the range, consolidate on Tuesday. Tuesday opens, make a low, and then make a high, taking out previous day high. So when we do that, what we do is a purge and revert. It did not make a fair value gap when it went through it, right? Look at this. So it took out the previous day high, but is our sell side, what is our objective? The previous day low. It took out the previous day low right in the next few hours. In the morning, towards 12 p.m., it took out the previous day low. Then it consolidates over here. Wednesday opens, we make a low. This is a minor buy side. We make a fair value gap through that buy side. So what we will do a retracement. We will not take this low. This is a protected low. And then we go up because this is a continuation. We take out Tuesday's high by making fair value gaps over here. See, when this price level was taken out, we made a fair value gap over here. We made a breakaway gap over here as well, and we went up. We made the high, the all-time high on that day. Since this would be a continuation, probably what we do is we wait for it to retrace. On Thursday opens, makes a high, retraces back into at least the 50% of the range of this price level, the discount and the premium we talked about. into this breakaway gap. This was also a breakaway gap. Okay, it goes down, and then we see a bullish model play out towards these engineered highs over here. Now when Friday opens, it takes out all these highs over here, but it does not take this high, and we see an SMT with ES on here. When an SMT is in play, we can expect the price to reverse. Here, these are almost relative equal highs. We revert and the price dumped where Trump talked about putting more tariffs on China. So you can see how, knowing what happened on Monday, we can anticipate what's going to happen on Tuesday, and what happened on Tuesday, we can anticipate what happens on Wednesday. And when we see what happened on all these 3 days, we can anticipate what happens on Thursday and Friday. Now, we will look at the daily delivery. And in a daily delivery, we'll look at the sessions: Asia, London, New York, AM and PM. We have to understand that price depends on the previous session, on a daily one. So what happens on October 8th, Wednesday, 25, Asia consolidates a little bit, makes a high, makes a low. And as soon as London opens, what it does, it purges the Asia low. When it purges that, what is over buy side? This is Asia high. We can take a trade, this trade. As you can see, it did not make a fair value gap while displacing through it. So what happens is that it goes back. Now we made a fair value gap over here while displacing through this value. So what we can expect a retracement into an optimal trade entry or a 0.5 into a discount of this level. Come down, but as you can see, even when we were coming down here, it took out the previous cycle high, which we'll talk about later. So we come down into the 50% of the range, and then we go up. So what happened was London set the low of the day. Asia helped us understand what London will do. Took out the Asia low, then we knew we were going towards London high, Asia high. And when we saw that how the Asia high was taken by making a fair value gap into the London high over here, that means that we'll see a continuation with a retracement back into the range. We retraced back and see continuation in the morning session. And since the morning session just went up like that with the fair value gap on this price level, we will see continuation. It did not retrace that much, but it just went up. So it will not always be perfect. You have to keep that in mind. Now that was the whole day. Now when I showed you the whole day over here, I showed you from 8 p.m. to 4 p.m. Now we'll talk about this small sections in between. Sessions mean just the London session, just the New York session, just the PM session, right? That's what I'm talking about here. Cycle 1, cycle 2, cycle 3. So in London session, we have 3 cycles, 1, 2, 3. In New York session, we have 1, 2, 3 sessions. Then we have in PM 1, 2, 3 session. That's what I'm talking about. Each cycle depends on the new one. So let's look at each of these sessions individually. So London's first session took out the previous session low, made a high. Then the next session opens, takes out the high of the previous session. Then when the next session opens, it takes out the low of the previous session. And the upcoming session opens up, takes out the previous session high and goes towards and takes out this low of the previous session. So you see, it's just taking out the previous session's liquidity all around. So what happens the next one, we took out the previous session sell side, which we talked about over here. In New York AM, took that out and then went up, took out the buy side liquidity. Now here we have made a fair value gap while going through this price level. So we will see a little bit of retracement and then rush up. So now in the AM session, we know we have to see continuation. We will not be taking out the previous session liquidity. So what happens is we see continuation, and as you can see, we retrace a little bit into the range and then see continuation again. We make a fair value gap towards through this level, so that means we'll see more continuation. So as you can see, we went up, come back, retraced a little bit. You take out the previous session again with the fair value gap over here. As you can see here, we had an opportunity to enter when we retraced back into the 50% of the range of this price level from here to here of the previous session. Took out this liquidity. Actually, no, we made relative equal lows, and then we rushed up again. End of the day. So you see how you can just tell if it will be a purge and revert or a continuation of the price. That's how you can look at it through each sessions. Okay, I thought it would be an hour-long lecture, but it was pretty quick. I guess I did not add a lot of sauce in the lecture, but we can talk about that later. So final notes, we talked about the price cycles. Our price goes from A to B from different levels. A 0.25 level, 0.5 level, 0.75 level. Like if we are going from 100 to 200, we go from 125, 150, 175, and 200. We go in these quadrants. Price moves in these quadrants. And then we talked about time cycles, how everything is the same in the lower time and in the higher time. If you look at the daily delivery, it moves the same way as the 90-minute or a 1-minute delivery moves. It takes out the previous session low or high and goes towards the opposing liquidity. I hope you found this insightful. And now it's time for homework. So what I want you to do is to go on all these charts over here, label your session of interest, note if there was a purge and revert model in play or a continuation model in play, and see how the previous session liquidity played a role. Because I'm a day trader and I'm teaching day trading, so I want you to look at the previous session's liquidity as a whole, and then find 10 examples each for the purge and revert and the continuation model. Okay, and with this lecture comes to an end, and I'll see you in the next lecture. Good day and good trading.